Class 11 Accountancy Numerical Problem Solutions. Presented by Eduxir.com. In this video, we are going to provide depreciation, provisions and reserves. Problem 8 solution. The problem statement is as follows. The following balances appear in the books of Crystal Ltd on January 1st, 2000 XD. Machinery account on 15 lakh rupees. Provision for depreciation account 5,50,000 rupees. On April 1st, 2000 XD, a machinery which was purchased on January 1st, 2000 XA for 2 lakh rupees was sold for 75,000 rupees. A new machinery was purchased on July 1st, 2000 XD for 6 lakh rupees. Depreciation is provided on machinery at 20% per annum on straight line method. And books are closed on December 31st every year. Prepare the machinery account and provision for depreciation account for the year ending December 31st, 2000 XD. Before we proceed with the analysis of this problem, let's first do a small recap. In case of assets or expenses or losses, any increase in any of these should be debited and any decrease should be credited. With this information at our disposal, let's now proceed with the analysis of the given problem. This problem requires us to prepare the machine account as well as the provision for depreciation accounts. It is also given in the problem that we have to prepare these accounts for year ending with December 31st, 2000 XD. In other words, we have to prepare these accounts only for one accounting period. Also note that as we are selling a machine, it makes sense to prepare the machine disposal account also. So let's prepare it even though it's not asked for in the given problem. See, we are selling a machine in this accounting period, but this machine was purchased in one of the previous accounting periods. For your information, for each accounting period, the following will be the start and end dates. Note that we need to prepare the ledger books only for one accounting period, but at some point, we need to consider the information that belongs to other accounting periods also. The first accounting period starts on January 1st, 2000 XA and ends on December 31st, 2000 XA. The second accounting period starts on January 1st, 2000 XB and ends on December 31st, 2000 XB. The third accounting period starts on January 1st, 2000 XC and ends on December 31st, 2000 XC. The fourth accounting period starts on January 1st, 2000 XD and ends on December 31st, 2000 XD. Also note that as per the problem, we have to prepare the machine and provision for depreciation accounts only for the fourth accounting period. Also remember that wherever applicable, at the start of the accounting period, the first entry would be any balances brought down from the previous accounting period. Also recall that the first thing that is considered in the given problem is the balances brought down from the previous accounting period. The depreciation is calculated on the last day of the accounting period. And the last entry would be any balances carried down to the next accounting period. Now let us start with the analysis of the transactions given in the problem. It is given that the balance of the machine account is 15 lakh rupees. We know that when a machine is purchased, we debit the machine account and credit the bank account. Let me make the things more clear here. These machines are not purchased now. They were purchased in the past. After purchasing these machines, they will be ultimately posted to the machine account. In this accounting period, we have to bring down the balance of all these postings done in the previous accounting periods. So, even though it is not specified in the problem, the balance in the machine account indicates a debit balance, right? Also, as there are not many transactions in the problem, let's not prepare the journal book and post these transactions directly to the corresponding ledger accounts. So let's post this balance related entry on the debit side of the machine account. Let's first create the format for the machine account as it is not yet created. Let's first write the title as machine account. Let's then write the headers DR and CR to designate the debit and credit sides respectively. Let's now have the individual columns for date, particulars, journal folio, and amount in rupees on both the debit and credit sides. As this is the first posting in the machine account, let's first write the year in the date column. Let's then write the date. Let's then write to balance brought down in the particulars column. Let's then write the debit balance amount of 15 lakh rupees in the amount column on the debit side. With that, we have completed the posting of the balance related entry in the machine account. Let's come back to the problem to analyze the subsequent transactions. It is also given in the problem that along with the balance of the machine account, the balance of the provision for depreciation account is also brought down. Recall that when the business is maintaining the provision for depreciation account, we need to post the depreciation related transactions by debiting the depreciation account and creating the provision for depreciation account. This also means that the provision for depreciation account will have a credit balance at the end of the accounting period. So this implies that this balance of the provision for depreciation account is a credit balance, so we should post it in the provision for depreciation account on the credit side. Let us first create the format for provision for depreciation account as it is not yet created. Let us first write the title as provision for depreciation account. Let us then write the headers DR and CR to designate the debit and credit sides respectively. Let us now have the individual columns for date, particulars, journal folio, amount in rupees on both the debit and credit sides. Now, as this is going to be the first entry, let us first write the year in the date column. Let us then write the date. Let us then write by balance brought down in the particulars column. Let us then write 5,50,000 rupees in the amount column on the credit side. With that, we have completed the posting of the provision for depreciation account related balance in this account. Let us now consider the next transaction. It is given in the problem that the business has sold out the machine purchased for 2 lakh rupees for 75,000 rupees. Note that this machine was purchased during one of the previous accounting periods on January 1st, 2000 XA. We are now selling this machine. Let us first analyze this transaction. Let us first write 1 to indicate that this analysis is for the first machine. Now, at the beginning of the accounting period, the business has certain number of machines. The total acquisition cost of all these machines is 15 lakh rupees. This is what given in the problem as the balance of the machine account, right? Now, among the group of these machines, it is given that one of these machines is purchased on January 1st, 2000 XA. The acquisition cost of this machine is 2 lakh rupees. Now, the business has sold this machine for a price of 75,000 rupees. Note here that the business did not sell all the machines. It is selling only one of those machines. As we have discussed in the previous problems, just before selling these machines, we have to calculate the depreciation on this machine and post it in the accounts. So let's proceed with the calculation of depreciation in the depreciation chart. Let us first write the title as depreciation chart. Let us then write the headers year, machine, acquisition cost, duration, calculation, and finally depreciation. Let us first write 2000 XD as the year in the year column. Let us then write machine 1's sold part in the machine column as we are going to calculate the depreciation only on the sold part of the machine among this group of machines. As per the problem, the acquisition cost of the sold machine is 2 lakh rupees. Now, the current accounting period is starting on January 1st, 2000 XD. And we are selling this machine on April 1st, 2000 XD. From January 1st, 2000 XD to April 1st, 2000 XD, it is 3 months, right? So, the duration for which we need to calculate the depreciation is 3 months. Now, if we multiply the acquisition cost of 2 lakh rupees with the yearly depreciation rate of 20 upon 100, we get the yearly depreciation or depreciation for 12 months. Now, to get the depreciation for 3 months, let's multiply this yearly depreciation with 3 upon 12. Let's cancel 2 zeros in 100 for the 2 zeros in 2 lakh rupees. Now, cancelling with 3, 3 ones are, 3 fours are. cancelling again with 4. 4 ones are, 4 fives are. Now, if we multiply the remaining 2000s with 5, we get 10,000 rupees, which represents the depreciation so far on the machine being sold out. Now, we know that for posting this depreciation, we should debit the depreciation account and create the provision for depreciation account. As the preparation of the depreciation account is not in the scope of our problem, let us leave out the debit part of this transaction and post the credit part of this transaction in the provision for depreciation account. As we have already discussed, this accounting period starts and ends in the same calendar year. So we are going to post the provision for depreciation related posting also in the same year as the balance is brought down. The year of posting is already there. Now let's write the date on which the depreciation is being posted into the date column. Let's then write by depreciation account in the particulars column. Let's then write machine 1 sold out parts depreciation amount of 10,000 rupees as additional information. Let's then write the total depreciation amount of 10,000 rupees into the amount column. With that, we have completed the posting of the depreciation related transaction into the provision for depreciation account. Let's now continue with further analysis of the disposal of one machine from the first group of machines. Let me first tell you what happens when a machine is purchased. When a new machine is purchased, the machine asset of the business will be increasing, and so we should debit the machine account. At the same time, as this machine asset is purchased by paying through check, and as this check will be collected through bank, we should credit the bank account, right? Now, when a machine is sold out, it immediately comes to our mind that we should credit the machine account as the machines will be decreasing. And as the business will receive the payment for the sale of this machine in the form of check, and as this check will be encashed through bank, we should debit the bank account. However, this accounting treatment is good and is applicable only if we are selling the machine as a scrap. But in our case, we are selling this machine before the end of its useful life. I mean, before it becomes scrap. So this accounting treatment is not applicable in this case. So what should we do now? In this case, we are selling the machine before the end of its useful life. So we should first transfer the machine from the machine account to a special account, namely machine disposal account. See, when we post the machine to the machine account, we post it on the debit side, right? In the same way, when transferring the machine from the machine account to the machine disposal account, we should post it on the debit side of the machine disposal account. Now, the machine is lying in the machine account and also in the machine disposal account. In other words, the same asset is posted to two ledger accounts, which doesn't make sense, right? So what we need to do is that we should create the machine account when transferring the machine from the machine account to the machine disposal account. So to summarize, for transferring the machine from machine account to the machine disposal account, we should create the machine account and debit the machine disposal account. This will complete the transfer. Now, what is the amount that we should post in the amount column? As we are maintaining the provision for depreciation account, we should post the acquisition cost of the machine in the machine account. So to be more specific, we should debit the machine disposal account with 2 lakh rupees and credit the machine account with 2 lakh rupees. Also note that it is not the acquisition cost of all the machines. It is just the acquisition cost of the machine that is being sold out. With this analysis at our disposal, let us now proceed with the posting of this transaction in the machine disposal account. Let us first create the format for the machine disposal account as it is not yet created. Let us first write the title as machine disposal account. Let us then write the headers DR and CR to designate the debit and credit sides. Let us then have the individual columns for date, particulars, journal folio, and amount in rupees on both the debit and credit sides. As this is the first entry, let us first write the year in the date column. Let us then write the date. Let us then write machine account for the sold out part of the machine in the particulars column. Let us then write 2 lakh rupees in the amount column. With that, we have completed the posting of the debit entry for the transaction related to the transfer of the sold out machine from the machine account to the machine disposal account. Let us now proceed to post the corresponding credit entry in the machine account. As this will be the first entry on the credit side of the machine account, let us first write the year in the date column. Let us then write the date. Let us then write by machine disposal account in the particulars column. Let's then write the credit amount of 2 lakh rupees in the amount column. With that, we have completed the posting of the credit entry related to the transfer of the machine from the machine account to the machine disposal account. Let's now analyze the next transaction related to the machine disposal. We know that after calculating the depreciation at the end of the accounting period, we post it by debiting the depreciation account and creating the provision for depreciation account. Right? Now, when the machine is being disposed, we have to transfer the depreciation amount from the provision for depreciation account to the machine disposal account. When we post the depreciation to the provision for depreciation account, we post it on the credit side, right? So, when transferring the depreciation related amount from the provision for depreciation account to the machine disposal account, we should post it on the credit side of the machine disposal account. The corresponding debit entry would be in the provision for depreciation account. Now, as given in the problem, we have 5,50,000 rupees of balance brought down. But we cannot transfer all these 5,50,000 rupees to the machine disposal account. This is because this balance brought down is not just for the sold out machine. It includes the depreciation amount for the sold out machine as well as the retained machines. We have to transfer only that part of the provision for depreciation amount from this total amount to the machine disposal account, not all these 5,50,000 rupees. Also, in this accounting period, we have created an additional 10,000 rupees to the provision for depreciation account. This should also be transferred to the machine disposal account. Now, the question is how to find all this amount that is related to only the sold out machine. Well, we know that this machine that is sold out is purchased on January 1st, 2000 XA, right? This date is on the first day of the first accounting period. So, let's first find out how much time has passed out from the purchase of the machine to the date on which this machine is sold out. Now, as this machine is purchased on the first day of the first accounting period, in the first accounting period, the depreciation was calculated for 12 months. In the second accounting period also, the depreciation was calculated for 12 months. In the third accounting period also, the depreciation is calculated for 12 months. In the fourth accounting period, as the machine is sold out on April 1st, the depreciation is calculated for just 3 months. Overall, the depreciation is calculated for a total of 39 months. Now, if you multiply the acquisition cost of 2 lakh rupees of this sold out machine with the yearly depreciation rate of 20 upon 100, we get the depreciation for 1 year or 12 months, right? However, we have to transfer all the depreciation calculated on this machine so far. In other words, we have to transfer 39 months of depreciation to the machine disposal account. So let's multiply this yearly depreciation with 39 upon 12. This will give us the depreciation for all the 39 months. Let's cancel 2 zeros in 100 for the 2 zeros in 2 lakh rupees. Now cancelling with 3 13s are, 3 4s are. Now cancelling again with 4 1s are, 4 5s are. Multiplying all the remaining values, we get 1,30,000 rupees, which represents the depreciation for 39 months. Now we have to transfer all these 39 months depreciation to the machine disposal account. To summarize, we have to debit the provision for depreciation account with 1,30,000 rupees and credit the machine disposal account with 1,30,000 rupees. Let's now post these entries into the corresponding ledger accounts. Now this transaction requires us to debit the provision for depreciation account, and as this is going to be the first posting on the debit side of the provision for depreciation account, let's first write the year in the date column. Let's then write the date. Let's then write machine disposal account for the sold out part of the machine 1 in the particulars column. Let's then write the debit amount of 1,30,000 rupees in the amount column on the debit side. With that, we have completed the posting of the debit part of this transaction into the provision for depreciation account. Let us now proceed with posting the corresponding credit entry into the machine disposal account. As this is going to be the first entry on the credit side of the machine disposal account, let's first write the year in the date column. Let's then write the date. Let's then write the provision for depreciation account for the sold out part of the machine 1 in the particulars column. Let's then write the debit amount of 1,30,000 rupees in the amount column. With that, we have completed the posting of the credit part of this transaction on the credit side of the machine disposal account. Let's now proceed with the transaction related to selling of this machine. Now this machine is sold for 75,000 rupees. Recall that this sold out machine is now part of the machine disposal account, as we have transferred this machine from the machine account to the machine disposal account. Now when a machine is sold out, the machine asset available with the business will be decreasing, and hence we should create the corresponding assets account. As this machine is now part of the machine disposal account, we should create the machine disposal account and not the machine account. At the same time, as the payment for the sale of this machine is assumed to be received in the form of check, and as this check will be realized in the bank asset available with the business will be increasing, and hence we should debit the bank account. However, as the preparation of the bank account is not in the scope of this problem, let us leave out the debit entry and directly post the credit part of this transaction into the machine disposal account on the credit side. As the date and year of this transaction is same as the previous transaction on the credit side, we can skip the year and the date. Let's then write by bank account into the particulars column. Let's then write the credit amount of 75,000 rupees in the amount column on the credit side. With that, we have completed the posting of this transaction into the machine disposal account. In fact, we have completed the posting of everything related to the machine disposal. Let us now consider the next transaction in this problem. Now, the next transaction is related to the purchase of a new machine on July 1st, 2000 XD for 6 lakh rupees. Let's first write 2 to indicate that this analysis is related to the purchase of the new machine. Now, the date of this transaction is July 1st, 2000 XD. In this transaction, the business has purchased a new machine and has paid 6 lakh rupees for purchasing this machine. So, the acquisition cost of this machine is 6 lakh rupees. As we already know, when a new machine is purchased, we should debit the machine account and credit the bank account. Now, as the preparation of the bank account is not in the scope of this problem, let us leave out the credit entry and let us directly post the debit entry into the machine account. Let us first write the date in the date column. Let us then write the bank account related to the purchase price of machine 2 into the particulars column. Let us then write the debit amount of 6 lakh rupees into the amount column on the debit side. With that, we have completed the posting of this transaction on the debit side of the machine account. Now, as there are no more transactions in this accounting period, let's proceed with the calculation of the depreciation at the end of the accounting period in the depreciation chart. Let's first write machine 1, which is retained by the business, in the machine column. Now, the total acquisition cost of all the machines is 15 lakh rupees. From these 15 lakhs worth of machines, we have sold out a machine worth of 2 lakh rupees. Now, the acquisition cost of all the retained machines need to be considered for calculating the depreciation at the end of the accounting period. So, from the total acquisition cost of 15 lakh rupees, let's subtract the acquisition cost of the sold out machine, which is 2 lakh rupees. Subtracting, we get 13 lakh rupees. This is the acquisition cost of the first group of machines that are retained by the business. So, let's write 13 lakh rupees in the acquisition cost column. Now, we need to calculate the depreciation on all these retained machines for the entire year. So, let's write 12 months as the duration for which we are going to calculate the depreciation on this retained part of the first group of machines. Now, if you multiply the acquisition cost of 13 lakh rupees with the yearly depreciation rate of 20 upon 100, we get the depreciation for 12 months. Let us cancel 2 zeros in 100 for 2 zeros in 13 lakh rupees. Now, if we multiply the remaining value of 13,000 with 20, we get 2,60,000 rupees, which is the depreciation on retained part of the first group of machines. Let us now proceed with the calculation of the depreciation on machine 2. Let us first write machine 2 in the machine column. Let us then write the acquisition cost of the machine 2, which is 6 lakh rupees, in the acquisition cost column. Now, this machine is purchased on July 1st, 2000 XD. And we are going to calculate the depreciation on December 31st, 2000 XD. From July 1st to December 31st, it is 6 months, right? So, the duration for which we need to calculate the depreciation on machine 2 in this accounting period is 6 months. Now, if you multiply the acquisition cost of the machine 2, which is 6 lakh rupees, with the yearly depreciation rate of 20 upon 100, we get the depreciation on machine 2 for 1 year or 12 months. However, in this accounting period, we need to calculate the depreciation only for 6 months on this machine. So let's multiply this yearly depreciation with 6 upon 12. This will give us the depreciation for 6 months. Let's cancel 2 zeros in 100 for the 2 zeros in 6 lakh rupees. Now cancelling with 6, 6 ones are, 6 twos are. Again cancelling with 2, 2 ones are, 2 tens are. Now multiplying the remaining values, we get 60,000 rupees, which gives us the depreciation for 6 months on machine 2. As we know, we need to post these depreciations by debiting the depreciation account and creating the provision for depreciation account. Now, as the preparation of the depreciation account is not in the scope of our problem, let's leave out the debit entry and let's directly post the credit entry into the provision for depreciation account. Let's first write the date in the date column on the credit side. Let's then write by depreciation account in the particulars column. Let's then write the machine 1's retained parts depreciation amount of 2,60,000 rupees as additional information. Let us also write the machine 2's depreciation amount of 60,000 rupees as additional information. Let us then write the total depreciation amount of 3,20,000 rupees into the amount column on the credit side. With that, we have completed the posting of this transaction into the provision for depreciation account. As there are no more transactions in this accounting period, let us now proceed with finding the totals, balancing the accounts and closing the books. Let us start with the machine account. The total on the debit side of the machine account is 21 lakh rupees. The total on the credit side of the machine account is 2 lakh rupees. From the total on the debit side, which is 21 lakh rupees, if we subtract the total on the credit side, which is 2 lakh rupees, we get 19 lakh rupees. This is the surplus on the debit side and it represents the debit balance. Also, as the machine account is a real account, this balance should be carried down to the next accounting period. So let's first write the date. Let's then write balance carried down into the particulars column. Let's then write the debit balance amount of 19 lakh rupees into the amount column on the credit side. Now the total on the debit side of the machine account is 21 lakh rupees. And the total on the credit side of the machine account is 21 lakh rupees. So now the machine account is balanced. Let us now find the totals in the provision for depreciation account. The total on the debit side of the provision for depreciation account is 1,30,000 rupees. The total on the credit side of the provision for depreciation account is 8,80,000 rupees. From the total on the credit side, which is 8,80,000 rupees, if we subtract the total on the debit side, which is 1,30,000 rupees, we get 7,50,000 rupees. This is the surplus on the credit side and it represents the credit balance. As the provision for depreciation account is also a real account, this credit balance should be transferred to the next accounting period. So let us first write the date. Let us then write balance carried down into the particulars column. Let us then write the credit balance amount of 7,50,000 rupees into the amount column on the debit side. Now the total on the debit side of the provision for depreciation account is 8,80,000 rupees. And the total on the credit side of the provision for depreciation account is 8,80,000 rupees. So now the provision for depreciation account is balanced. Let us now find the totals in the machine disposal account. The total on the debit side of the machine disposal account is 2 lakh rupees. The total on the credit side of the machine disposal account is 2,05,000 rupees. From the total on the credit side, which is 2,05,000 rupees, if we subtract the total on the debit side, which is 2 lakh rupees, we get 5,000 rupees. This is the surplus on the credit side and it represents the credit balance. Now, as the machine disposal account is a nominal account, it should be closed by transferring this credit balance to the statement of profit and loss account. So let's first write the date on the debit side. Let's then write profit and loss account in the particulars column. Also note that as this is a credit balance, it should be transferred to the profit and loss account as profit. Let's then write the credit balance amount of 5,000 rupees into the amount column on the debit side. Now the total on the debit side of the machine disposal account is 2,05,000 rupees. And the total on the credit side of the machine disposal account is 2,05,000 rupees. So now the machine disposal account is also balanced. With that, we have come to the end of this problem. Thanks for watching. Eduxir.com is started to promote effective and efficient learning process to help the students with their learning requirements. To watch all our videos, please subscribe to our channel. Also, please click on the bell icon to receive a notification as soon as a new video is published. Please click on the like button if you like this video. Thanks for watching.